Loans versus grants for a charity. Social enterprise. Traditionally, charities have been able to fund themselves by raising grants from government-sponsored commissioners of services or from private donations, legacies, and fundraising events. In the UK and elsewhere, many of these sources have been severely strained since the financial crisis of 2008. Since then, there has been a prolonged period of austerity. The UK government has pared back government expenditure on welfare and other items to reduce the fiscal deficit. Local authority funding has been especially impacted, with central government funding reduced by about 40% since 2010. Charities and social enterprises have moved into services previously provided by government. They have tendered for contracts with local authorities, which act as commissioner and obligor. Under these contracts, the charity now delivers services to the vulnerable. This has required working capital finance, as charities have sought to expand their role. Further complicating matters, local authorities and other commissioners have delayed payments under these contracts. They have borne down on any profit margin that might be extracted by the charity. Sometimes they have introduced payment by results contracts. In short, the financial requirements of charities have increased as grant funding has dried up. This is where social investment has stepped in to take up the slack. These social investors make loans with traditional terms and conditions, usually a fixed or variable rate of interest, some light financial and other covenants, and of course the requirement to repay at the end of the loan. This is more onerous than grant funding, which is sometimes viewed as the equivalent of equity finance for a charity. But it also has advantages. It imposes on the charity a financial rigour that may allow the charity to become more sustainable. The charity can use this discipline to identify service-related cash flows that have some reliability. This allows them to budget for debt service and principal repayment. In fact, grants often have debt-like characteristics for the charity. For example, if they are financing an asset purchase like a property, they will often have a security interest. Equally, there can be clawbacks such that the grant must be repaid if the associated service is not adequately delivered. This would tend to include failure to deliver through insolvency. Hence, grant providers will frequently occupy a seat at the senior creditors' table in administration proceedings. From the perspective of the social investor, the sustainability that debt discipline can provide is an aspect of their social impact. This aspect can appeal to philanthropists as funders of social investment funds. By contrast, with grants, the money that goes out the door can be difficult to follow. Grants can be associated with uncertain tangible results. Yet the philanthropic social investor can view debt as akin to recyclable grants, where the principal of the loan is repaid, the capital contributed to the fund is typically invested in another charity or social enterprise to accumulate greater impact over a wider horizon.